A severe crisis is unfolding in China, worse in 2008 and 2015. This is the latest Forex and stock market news we need to be paying attention to. And I'm going to show in today's video the currency most at threat from these latest developments, as well as some of the stocks we can look at to the long side and the short side based on what's happening in China. The world's biggest steel producer warns of severe industry crisis. Iron ore collapses to lowest since last year on demand outlook. Cash now more important than profit, China Baowu boss says. The world's biggest steel producer has sounded the alarm about an industry crisis in China that carries the potential to ripple around the globe and plunge the sector into a deeper downturn. Conditions in China's steel sector are like a harsh winter that will be longer, colder, more difficult to endure than we expected. China Baowu Steel Group Corp chairman Hu Wangming told staff at the company's half-year meeting, warning of a worse challenge than major traumas in 2008 and 2015. Hu's stark message will likely be a worry for rivals across Asia, Europe and North America as they grapple with a fresh wave of Chinese exports. Often by pushing for trade measures, shipments from China are on track to reach about 100 million tons this year, the highest since 2016. So what we're seeing here is, and why this is important, is we're seeing this domestic slowdown in China, especially in the housing market, which of course is where there's tons of demand for not just iron ore, but copper and all these other commodities. And as a result, we're seeing a massive oversupply of iron ore, and it's driving the price down. I'm going to show you why this is important, not just for China, but globally. So you can see as Chinese domestic demand is weakening, we're starting to see steel margins under pressure. And a survey of China's steel industry points to difficult conditions. Among the findings, 50% of mills were said to be losing money, with a further 23% just breaking even. So we're looking at a situation where mills in China are running at roughly 73% of them not actually making any money. Steel mills in China, the biggest iron ore importer, and this is the key, have suffered from lackluster demand and sinking product prices, and many of them are cutting back on output. So what happens when the largest importer of iron ore starts to cut back because of slowing domestic demand in China, because of the unwinding of the housing market bubble we've seen in China recently? Well, of course, the price of iron ore crashes because there's no demand for it. And iron ore futures in Singapore are set to reach the lowest since 2022 because of this. So as traders, what should we be looking out for here? Where are the trade ideas that we can keep an eye on, add to our watch list, or even look to add into our portfolio? Well, if I pull up this downloadable spreadsheet from the GMT trading course, which is accessible to all members of GMT as part of their membership, you can find out more about GMT membership in the link in the pinned comment and the description below. But this sheet shows you exactly the problem that we're seeing here because of this crashing iron ore price. We're seeing a demand shock out of the largest importer of iron ore in the world. And it's essentially down here at the manufacturer side, which is causing the raw material, iron ore itself, to crash. And what does a demand shock, which causes the raw material or the commodity to fall in price, do? It causes a short currency bias on the exporting countries of iron ore. So which country's currency is most exposed to this demand shock out of China? And the answer is Australia's currency, the Australian dollar, because if we look at this data from 2022 and nothing has really changed since, you see exports in 2022 out of Australia amounted to 87.9 billion in iron ore, making it the first largest exporter of iron ore in the world. And what was the main destination of iron ore exports from Australia? It was China, with a whopping 72.5 billion out of the 87.9 billion exported in 2022. So Australia's biggest customer is China by far, with about 82% of all iron ore exports in 2022 going to China. And that's exactly where we're seeing this demand shock. Now you can see if we look at the Australian dollar futures in the candlestick chart here, overlaid with this red line, which is the iron ore futures price in Singapore, you can see the Australian dollar tracks the Singapore iron ore futures prices. And this is again because of how exposed the Australian economy is to iron ore exports. And what we're seeing here is we're starting to see a divergence where we're getting some strength come into the Australian dollar, but we're seeing iron ore still making new lows and possibly even going to continue lower over the back end of this year. And this really sets up a fundamental bearish bias in the Australian dollar. And if we jump over to the Hedge Dash quantitative trading platform, you can see that there's a couple of things to pay attention to here. We've just looked at the iron ore price going down as the Australian dollar is rallying. We're now starting to get overbought on a rolling daily basis, sets up roughly a 70% chance of pausing or reversing from these areas. If I overlay the weekly levels, you can see we're becoming overbought intra-week, and in fact, we've started to reverse right at the upper bound highlighted from Monday and from last weekend in the Hedge Dash trading platform. And these are leading levels because these are what we get at the weekend for the week ahead. So this level where the market is now turning was actually on this chart in the Hedge Dash trading platform from the beginning of the week. So we had this as a leading signal where we start to reverse from above this level. Now, if I overlay the monthly as well, you can see we're not just overbought intra-week, but we're also overbought intra-month. We're starting to break above the monthly upper bound, and again that puts only roughly a 30% chance of continuing higher, 70% chance now on a monthly time horizon and an intra-week time horizon that we are set to pause or reverse lower in Aussie dollar. So keep an eye on that divergence between the Australian dollar and the iron ore price, because if iron ore continues down, the Australian dollar is likely to snap back lower as there's less demand for the currency through the balance of payments. Now, it's not just iron ore exporters who are exposed to this sell-off in the iron ore price. There are also a number of US stocks that are set to suffer because of this crashing iron ore price. Now, if we go back to the chart, and all I've simply done is I've changed the Australian dollar in the candlestick chart to the Midwest Domestic Hot Rolled Coil Steel Index Futures. And what you can see here is that the iron ore price doesn't just correlate with steel, but essentially it leads it because iron ore, of course, is an input in the steel making process. So instead of looking at the steel price, because obviously we're looking at a crisis in the steel industry, but looking at the iron ore price instead gives us a little bit of a heads up when comparing it to individual stocks versus if we compare some of the steel producing stocks to the actual steel price itself, or HRC in this case. You can see iron ore peaks, steel rolls over. Iron ore bottoms, we start to see steel rallying. They're kind of coincident. Iron ore bottoms a little bit earlier, iron ore peaks a little bit earlier. They're kind of coincident over here, and now they're making their way down. So now we're going to look at a number of US stocks that are set to suffer, and these are stocks that are exposed to the iron ore price, and all of them have a correlation, as you can see, with iron ore. When iron ore comes down, they tend to sell off. When iron ore rallies, they tend to rally. When iron ore sells off, they tend to fall, etc., etc. And now we're seeing in United States Steel Corporation, this is the first one we're going to look at, we're seeing as iron ore prices come down, you can see the big sell-off this week. We've already started to see the divergence between iron ore going down and, as you can see in this case, Steel Corporation, United States Steel Corporation going up. You can see now this big solid down week where we're snapping back, and the divergence is closing between this stock and iron ore with a sell-off in the stock. So if you pull up the fair value models for X, you can see we're roughly at fair value. We're actually just slightly overvalued in this. It's one of the reasons why we're starting out by looking at this particular stock, because when you get a bearish or a bullish catalyst, you can very often see stocks that are exposed to that catalyst becoming overvalued or undervalued because of that catalyst. In other words, even though we only have roughly 3% back to fair value in this stock, if we get a real shock and this sells off hard, we could very easily see this coming down to the 26.12, where this stock would begin to become undervalued because of this demand shock out of China. So if we jump back over to the Hedge Dash system, you can see the 47.64. This is where, if we start to trade above this, fundamentally, again, we're not talking technicals, we're just talking about the valuation of the stock, we would start to become overvalued. And you can see previously above here, we started to sell back off, straight back down to fair value. And if we continue to see iron ore prices slide, keep an eye on this stock, because we've just started only in the last couple of days to see that divergence closing between this stock, which has until recently, until the last few days, been moving up as iron ore prices have been coming down. And now we've got a really strong sell-off. And this is a stock that, if we continue to get a very bearish catalyst, especially if we break this low, because this essentially would be a 1 and a 2, we could very easily see this stock becoming undervalued below 26.12 and also closing this gap in the process. So keep an eye on this stock if the iron ore price continues lower, because you have roughly 30% down to the 26.12 until this stock actually becomes fundamentally undervalued. Next, we're going to look at Nucor, ticker NUE, and you can see we are roughly overvalued by about 4.68%. So still quite a long way down to undervalued levels at the 116.25. Nucor is a manufacturer of steel products, and we've just seen as the iron ore price declines, so too very shortly after does the steel price. And if you are producing something and the price of it's going down, this is going to affect your margins. So you can see in Nucor, we're sitting above the fair value of 136.98, and I quite like the prior low over here as well. Very often you get this kind of stair step where we pull back, trade into this area. I do think we could see a retest of the 150, and from the 150 area we have roughly, where we are is about 5% down, we have roughly 8% just back to fair value. So if we pull back to 150 over the next couple of weeks or so, we've seen China coming out talking about maybe some supportive measures, and iron ore has got a short bounce. If we see Nucor pulling back to 150, that gives you roughly 8% down just to get back to fair value at 136.98. And if we start to sell off on the bearish catalyst over the back end of this year, you can look down to the 116.25 where we start to see this company become undervalued fundamentally, and you're looking at roughly 20%, 22% down from the 150 area. Next is BHP. Now this is actually an Australian company, and it specializes in the exportation of copper, iron ore, and also coal. And this of course is going to be affected in terms of earnings by any slowdown in China. This is a market that also correlates with the iron ore price. And as you can see, we're not overvalued, but we're not really undervalued. We're more or less at fair value. And so although we're not as overvalued as the previous two stocks that we just looked at fundamentally in this asset, we still have plenty of downside before this stock fundamentally becomes undervalued below the 44.66. So if you come have a look at this, and this is tradable on the New York Stock Exchange, you can see we're just sitting underneath fair value. And we also have this quite nice technical setup where we've got lows over here. We've also got lows over here which have now been broken. We kind of pulled back, retested, and we're sitting right underneath these prior lows, just underneath fair value. So any kind of consolidation, you can see this is trending down, sitting nicely below the 20 moving average. Any kind of consolidation period, the next leg down, very easily, if we continue to get iron ore prices selling off, could be anywhere up to roughly 17%, which is where we would get to the 44.64. Now, again, I'm not saying you're going to capture 17% or that this stock is even going to fall 17%. It's just between fair value and this stock becoming fundamentally undervalued, there's quite a lot of room to play with to the downside, whether you're looking for short-term trading opportunities or whether you're adding it into a portfolio as part of a long-short position and spread trade. So next stock we're going to look at is Rio, and the next three stocks differ from the previous three stocks in the sense that all of these ones coming up are deeply undervalued already, and so they're perfect candidates for consideration if we start to see an end to this crisis, if China steps in and starts to boost domestic demand and we see iron ore prices going back up. These are the stocks, either as part of a long short hedge to the upside, or we start to see an end of this crisis. These are the stocks that could really outperform to the upside because they're already beaten down so much near term. And you can see with Rio, we have roughly 20% back to fair value, and we're roughly 2% under the 64.59, making this company extremely undervalued on a fundamental basis. Now, if we jump over to the chart and look at the weekly time horizon, you can see we're already testing new lows below the 64.59. If we start to sell off near term on further iron ore sell off, and then we get the iron ore price rallying, because don't forget, you can see divergences between the two. If you get iron ore price rallying over the next month or so or into the back end of the year, keep an eye on this stock, because this, especially testing weekly lows, we could very easily see this get support if the iron ore price moves first, and we could see this start to recover, and we have roughly 20% just back to fair value in this material stock. The next beaten down stock exposed to the iron ore price is Vale, and you can see we're already starting to get towards extremely undervalued levels. In fact, just a week or so ago, we were at extremely undervalued levels. And this is certainly a stock to keep your eye on. If we start to turn the corner, if we see government intervention and we start to see domestic demand coming back in China, it's a very beaten down stock, which has quite a lot of potential to the upside from here. If we jump over to the daily chart, you can see we were recently below the 9.88. So given an extreme undervaluation of this company fundamentally, and we're looking at this on the New York Stock Exchange. And so coming into the next month or 2 months, we've got this kind of technical pattern we've broken down below it. If we come back down and we breach the 9.88 again and we start to kind of double bottom down here, and at the same time, again, you could start to see iron ore moving up first. If you start to see that corner turning and coming out of this crisis in China, which at some point we inevitably will, Vale from the 9.88, so extremely undervalued levels, has about 50% upside almost into the 14.71 or 15 handle. So in terms of value plays, especially if you're looking to add to a portfolio after the crisis passes, Vale back to fair value does present quite a lot of upside potential. Okay, so let's look at one final stock then that's very beaten down, very undervalued, and it's exposed to the iron ore price. And if we start to see this negative catalyst disappearing, in other words, we start to see domestic demand coming back in China, iron ore price turning in a significant way to the upside, this is another stock that could really benefit to the upside as domestic demand at some point comes back into the Chinese economy. And that stock is Cleveland-Cliffs. Now, this is a North American producer of flat-rolled steel, and it's exposed to the steel price. And as we know, as iron ore goes up and down, it tends to lead the steel price. So this is a stock that's very beaten down. You can see it's about 31.84% undervalued. And if we jump over to the chart, you can see in the weekly time horizon, we're approaching extremely undervalued territory at the 1157. So what I like about this stock is if this does push down further as the crisis continues to unfold near term, if we break this major low and we start to trade below the 1157, you're looking at roughly 55% upside just to get back to fair value at the 18.19. You can see this stock has been trading around this level historically. So another stock to keep your eye on the watch list for when this near-term crisis in China starts to subside and we start to see a rebound in the iron ore price. So that is it from me for today, guys. As always, I hope you enjoyed today's video, and if you did, why not consider joining us in the GMT training room each day, where I look at the best markets as well as sharing real-time setups that I'm personally looking at trading with members as part of our GMT training program. Don't forget, you can also get a 2-week free trial to the cutting-edge hedge-trading app used in today's video by heading over to www.hedge-.com. Access to the cutting-edge hedge-platform is included with every GMT membership.